My name is Josh, and this is the Built for Wealth podcast, a millennial's no BS guide to financial freedom. In this podcast, we are interviewing investors from all different spaces and backgrounds and gaining insights on just how they built their wealth through real estate that hopefully leaves you inspired to build yours. You can follow along at builtforwealthpodcast.com. And without further ado, we'll jump right into the show. Okay, we've got James Gaskin.
Hello.
From Renovo.
Thank you so much for having me. Excited to be here.
Of course. Thanks for coming out. One of the most common questions that I get from people is, how do we finance our deals? How do we fund our projects? And it's something that we do all the time, so it's kind of normal for us. And so I sometimes forget the intimidating factor of getting financing and all that's involved in that process. So why don't you just give us a brief overview who you are, who is Renovo, and then we can talk about how people can get their deals funded.
Love it. Yeah, happy to do it. Well, thanks again for having me. Excited to be here, just fresh off of an airplane. So hopefully this is okay. My name is James Gaskin. I managing director of corporate development and partnerships for Renovo, but I do. Yeah, I know it's a lot. But I do a lot of stuff for the firm. But just Renovo in general, to start there, is a real estate lender. We finance real estate investors exclusively. We don't make loans to homeowners, but we provide financing to acquire, renovate, build ground up, and then also own rental property. So think of us like a private bank for real estate investors, and we do that. We try to do that very locally. So we have offices with local teams in, I think we're probably up to 34 cities now. We've been expanding in California quite a bit. And all of that growth has really come in the last 5 or 6 years. We started in Chicago in 2011. We lending there for about 8.5 years before we expanded into more of a national footprint. Mm-hmm. And I've sort of led that expansion, hiring the sales teams, opening the offices, really helping those individual groups build their local businesses. And all of our loan officers kind of lend where they live and really focus in a particular market so we can bring the most value to our client. But at the end of the day, it's really all about finding investors that are, have some experience. We're typically we target investors that have a little bit of a track record at least. And we try to basically provide them with the fuel that they need to build their business, right? Typically it's, folks who want to grow and we can kind of provide that growth capital so that they can acquire more assets and dispose of them. And then, like I said, we do that kind of on the short-term side with fix and flip and ground up construction, and then multifamily value add and all kinds of things like that. And then, long-term rental product, DSCR for rental owners. And, probably loan sizes up to about 20 million these days, 15, 20 million. So, yeah.
What's the difference between you guys and a local bank?
Oh, that's an awesome question. Well, local banks can be good resources as well, and I think everybody should have good relationships with their local banks because those can be really valuable in certain circumstances. But Renovo, a bank, if you think about a bank, right, they're in the business of taking in deposits and then investing that capital for a return for the bank. And they lend that money out in all kinds of different things, right? Home loans, cars, equipment loans, business loans, right? Mm-hmm. As well as real estate. So banks typically don't have like a ton of people that are really experienced in what you do every day. We have nothing but those people. And because we're not subject to the same regulations that banks are, we can be a lot faster and more efficient. And that typically is very, highly valued by investors that are trying to move on opportunities quickly, especially in competitive markets like this one. So typically the difference is going to be, we might be a little bit more expensive because we're not taking in deposits for basically free. Right. So our cost of capital is a little bit different. So we're typically a little bit more expensive, but for that you get a lot smoother process, more predictable, right? Banks are pretty famous for saying yes until the very end and they're like, never mind. And so, we can kind of give our investor clients a more predictable, consistent, process and experience. And then it's typically much, much faster because we don't have to deal with all the red tape that a bank does.
Right.
So it's just a more efficient solution, and we're kind of designed just for this. And that helps us identify when we're looking at a deal and working with a customer, like understanding what exactly they're doing and having the expertise to quickly analyze and go, okay, that makes sense. Let's run with it, versus banks typically have one or two people that are doing that. And, it may be a while before they can kind of get around to getting the deal closed. And, that can be painful for investors.
What also is painful is the enema that they make you go through to try to get money. I feel like I've been through that process so many times with local banks, and they're like, man, we don't like it. We don't have an appetite for it.
Yeah.
Your financials don't look good enough. And I'm like, what are you guys talking about? Anyways, that's one of my biggest headaches with local banks. It's just impossible. There's so much red tape.
Yeah. The banks, are fairly famous for, kind of finding ways to say no. Because in the end, right, they're dealing with depositors' money. And so they have to be very serious about where they put that money. And again, I think the lack of like a robust team of real estate experts, especially the speculative real estate that we do, right? It's pretty easy for a bank to look at a 30-year fixed rate homeowner mortgage and go, okay, that makes sense. It's a little different to like take a look at what you're doing and, I want to build 4, ground up, new homes on this, large oversized lot that I bought, and, what's the market for that and how long is it going to take? And that's just it requires expertise.
Yeah.
But yeah, the bank's process is typically pretty onerous. And again, like they drag it out and you kind of don't know where you stay. Again, they tell you yes, 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 yes. And then something pops up at the very last minute that they should have known probably, but that can be very painful. And now, especially with, what happened in, 22, 23 with like the failure of Silicon Valley Bank and some of these banks that got caught up with a lot of office in particular, real estate loans.
Yeah.
A lot of those banks, and that's reverberated through sort of the regulatory apparatus that controls banks, that a lot of banks don't want speculative real estate on their books at all, right? They're just not interested, and they'll find ways to kill deals. And then if they'll do it, the requirements typically are pretty strong, right? Like, hey, yeah, we'll fund that, but you need to, you want a $400,000 loan, we need you to put $600,000 in cash in our bank. It's like, well, that doesn't really make sense, does it? So there's a lot of things like that you just don't have to worry about when you go through, a private entity like ourselves.
Right. Cool. Walk me through a typical like deal offering that you guys have. You said you guys do fix and flips, the rental loans, new construction. If somebody was to try to get financing for a fix and flip, what could they expect to have to bring to the table?
Yeah, I mean, most of our deals, and it's very borrower specific, obviously, but most of our deals are going to be, borrower typically brings somewhere between, call it, could be as little as 0, probably up to 15%, maybe 20% if it's, if there's some hair on the deal or whatever. But like typically it's, call it 5 to 15% is pretty normal that a borrower would bring. So the loan to cost, right? The actual, whatever the total cost of the project, acquisition and construction, we would typically cover 85 to 95% of that.
Wow.
And then the borrower brings the rest in cash. And, rates are, they move around, right? But like, 9s to 11 or so, 1 to 2 points is fairly typical. Pricing and leverage in this industry that we're in is fairly similar across lenders. So, that's probably pretty market, I would say. And we'll go up to 100 in certain circumstances for really good borrowers, depending on the type of project and things like that. But for the most part, call it 5 to 15% in for the investor. And then that's interest is charged on that as it's drawn. So typically, the construction budget is held back. And then as an investor is completing portions of the work, we would, do draw reimbursements for that. And then, that balance would tick up over time. So they're not paying, if it's 10%, right? They're not paying 10% on the full loan amount from day one, kind of steps up. And we just try to make that process as easy as possible. We try to, get draws out in 24 to 48 hours when we can. And, as try to be as borrower friendly as we can be, again, to try to, be a little bit better solution than the bank.
Yeah. So people can get the full financing for the purchase price and rehab costs?
Correct. Yeah. So typically it's 100% of the rehab costs, and then, call it 80 to 95% of the acquisition. So typically the borrower is bringing some cash to the close, and then we'll fund 100% of the construction that we reimburse. So when you're a customer of ours, right, when you do your deals, you do a phase of work and you submit a draw request, and we can do that virtually, or we have local people that run around and do that for us. And we pretty much do everything in-house that way. Try to facilitate the project getting completed and sold as quickly as possible. Because obviously we're in the banking business, and in the banking business, the most important thing is that you get paid back. Very easy to lend money out. It's a little harder to get it back. Getting it back is the hard part. And so we try to make sure we understand the risk up front, and that we work with good sponsors that know what they're doing and have a track record of completing projects. And for those investors, we want to build a really long-term relationship. So we don't want to be a transactional partner. We really want to, and that could mean lots of things over time, but that's why we have so much product is, as your business grows, and I know your business has grown a lot over the last handful of years, like we want to be able to evolve with you and continue to help you grow to the next level in whatever way we can.
I think it's wild that in today's investing landscape, somebody can find a property that they want to fix up, and they only have to bring 10 to 15% down. And then they make all the profit on the back end. And if you're buying something correctly, like the age old, investor percentage is, 75% of the market value, and then you subtract out your repair costs. If you've essentially baked in 25% in margin on that of the full all-in cost of the house, and you're only bringing 10 to 15% down, you're multiplying your money. It's such a fantastic way to explosively grow your investment, whatever little nest egg that you have. It's pretty cool. And I don't think that this is not something that's been around for a long time, right? This has become a lot more mainstream recently.
It has become a lot more mainstream. And that's right. I mean, real estate's you look back over time, right? A lot of the wealthiest families in the country and in the world are many of them developed a lot of that wealth out of real estate. And it's because it's such a highly leverageable asset, right? It's a lot easier to go and get a lot of debt and high leverage to acquire and renovate or build real estate. It's a lot harder to do that if you want to go invest in the stock market or other types of investments, right? So the leverageability of real estate is very solid, and it allows for those outsized kind of multiple returns, which is great. And you're a great example of how you can put that to work for yourself.
It works great for us. I love it. Yeah. Talk to me about the what does somebody need to do to be able to become financeable? Because you said you guys like people who have somewhat of a track record. The 0 to 1 of getting to the point of working with like a Renovo. What does somebody have to do?
Well, there's a lot of ways you can do it. Some of the best ways you do need typically, and there are lenders that that are in our industry, in our space, that are probably a little more open to a brand new investor, but they're, the terms on those deals are going to be tough. It is not as easy a process if you're starting, if this is your first deal, right? And typically you need to show some experience. Well, I've been a GC and I've done deals for other people, things like that, just to make sure that, because there's, better than anybody, right? There's a lot of surprises. None of these deals are typically very easy. And so, just being able to see around a corner or two because you've done it before is pretty important. But to build that experience, to be able to work with a firm like us, a lot of people start by partnering with somebody, right? And, they'll find somebody in their market. And I highly recommend this to anybody who's really interested in getting into this business, is find somebody who has done what you want to do, and then find a way to get in with them, right? Whether it's working for them for free, if that's what you have to do. I mean, if you're young and you have low overhead, you can afford to do that, right? Like whatever you need to do to have somebody to, kind of take you under their wing and to learn from their experience. If you can do that for a couple of deals, you have enough of a track record at that point to be able to go out and be financeable on your own. Of course, we typically don't give loans to people who have $0, right? You need cash to float these deals. Right. You need cash in case something goes, sideways or unexpected cost rate. There's all kinds of things that can happen. So, having a little bit of a balance sheet is important. And then I think just really understanding, becoming an expert on your market and on your asset, right? So, you're a ground up guy. You do a lot of ground up construction. Whatever it is you're going to do, I always recommend, number one, like geographically be focused, because real estate is a local business and it's a street by street business in a lot of markets, right? Knowing your market really, really well, that's going to help you avoid a lot of mistakes, because buying it right is the key. Mm-hmm. And if you don't know what the price of the house needs to be in order to get it to a point that you can sell it for whatever you're trying to sell it for, and whether or not that sales price is going to be absorbed by the market, that's a big, an easy way to get in trouble. So just learning that stuff by going through it. And a lot of times the easiest way is to partner with somebody who has a lot more experience than you. Yeah. There's other ways to do it, but I think that's probably the most simple way and the way that's going to get you the farthest, the fastest.
And even if it comes down to it and you have to split profit with them, or you're not making anything on it, just the rapid acceleration in your learning curve by working with somebody who has done it is totally worth it. When I remember the first deal that I did, I talked to a couple guys who they weren't really active flipping, like they had done a lot of real estate transactions in the past, and was asking for them to be private lenders on the first deal that I did. And the two of the guys that I did talk to who were like, there's just not enough meat on the bones. I'm not interested in it. I was like, whatever. You don't know. I mean, in the end, they were right. I mean, I only made like $1,000 on it, but yeah, I mean, I was that guy who was ignorant enough to think that I could figure it out on my own. I mean, eventually we did, but I think things would have gone a lot quicker, and that learning curve would have been shortened by a significant amount if I had that mentor that I was working with.
And I think a lot of people get hung up on that, right? Like, well, I don't want to give away, I found this great deal, I don't want to give away a bunch of the upside. But you got to think of, if you've not done it a lot and you're trying to build that track record, like you got to think of that as a cost. It's like getting a degree, right? You go to college, you pay tuition, and in exchange you learn all these things that you can then go and use to make more money later. Yeah. And I think people need to really understand that. Like, if you need to split profits on a deal, or even if you're giving away most of the profits, if you're learning from somebody who's very experienced and really knows what they're doing, you're going to get so much of an education. It is going to make you a ton of money later. So don't be too short-sighted, right? Yeah. You got to think long-term if this is what you want to do, and put yourself in the best position to succeed. Because the whole thing I said about leverage in real estate is true, but leverage cuts both ways. And if you make a mistake, you can find yourself basically unfinanceable, right? And so getting those early lessons as much as you can on someone else's sort of dime is a very smart thing to do.
Absolutely.
So, I mean, again, there's other ways to do it, but I think that's probably the best. That's kind of that would be my advice for sure.
What are some common pitfalls that you see from investors? I know that there's been one lending institution that has gone under recently, and then I know that Renovo's got a little bit of a different mindset coming out of the 2008 financial crisis. I think you guys have built things differently. Just talk to us about risk management from the institutional side, but also from like an investor. Like, what are some practical things that we can do?
I mean, I think speaking to the investor side first, I think, like I said a minute ago, like really understanding your market, and also understanding your budget and what it takes to complete one of these things, right? I mean, listen, if you want to build a house that sells for $800,000, like that house is going to be finished out differently. It's going to be laid out differently than a house that's going to sell for 300. And knowing that kind of stuff is really, really important. So I think knowing your market really well, and then knowing the real estate. And, we try to really help our customers in that way because, again, our lending teams are local. So they typically know the neighborhoods. You bring in a deal, like you work with Susan, you bring in a deal and Susan probably knows the neighborhood. A lot of our lenders have lived in the same city since they were, kids. So like they know all those streets and they can really help as well. Like working with the right lender can help you avoid some of those things because in our case, our loan officers have a lot of local expertise. And that can be really helpful in terms of just not, avoiding an avoidable mistake. I think that's a big one. Not having enough cash is another one. There are certainly lenders out there that will give you a loan if you don't have a ton of cash, but that's not always the best thing for you. Like having a nice cushion, and then understanding the numbers really well, right? Like we have customers that send in a budget and it's a number, right? Like have a detailed budget, like know where all the money is going. And especially now, right, with tariffs and things like that, like there are certain line items on your budget that could be more expensive than you thought, and understanding that budget really well. And then I think also picking the right partners, right? If you don't have construction experience, direct construction experience, you need to find a really good GC. And a great GC can save you a ton of headache. A bad one can be very, very expensive. And so I think really making sure you have really good partners, like check references, like work. And I think utilizing your local network is a huge part of it, to find those vendors and other folks that you need to get these projects done, finding the ones that are really good. I think that can be really helpful as well. And if you kind of miss on any of those things, you certainly have more of a potential for having painful lessons coming your way, right?
All right, let's talk about the rental stuff. You guys offer DSCR financing. What is that?
So DSCR stands for debt service coverage ratio, and it's the way that we size these loans. And effectively, it's permanent financing for rental property owners. And so it's very similar to the mortgage you might have on your personal home. Typically for loans, on single family assets in particular, like those are usually going to be 30-year fixed rate, just like your home mortgage. Rates in some cases are lower than, oddly enough, than personal mortgages, but they're in the similar range. And basically it's the ability to lock in fixed rate financing for a long period of time. And, you can always refinance that if rates move, but, it's a great tool for anybody who keeps, or is building a rental portfolio or what have you. It's a great tool. And we do quite a bit, probably 30 to 40, percent at least of our monthly volume is DSCR.
Oh, wow. That's a lot.
Yeah, it's a lot.
What's the typical term structure for something like that?
Yeah, I mean, typically, 30-year fixed rate, and we can lock rates for 45 days, which is kind of new, but that's huge to have some certainty in the rate while you're trying to get the deal closed. Most of our deals close in 2-3 weeks. Sometimes DSCR deals don't need to close that fast, so they don't, but we can move pretty quickly. But rates are in the 6s to 7s. Typically that's going to be 70 to 75 loan to value. But if you have acquired the property and done the work yourself, typically you have quite a bit of equity in that deal already because you've increased the value. So a lot of times it's no cash in on those deals. And then basically, again, 1 to 2 points, rates, like I said, in the 6s to 7s, that moves around a lot because those rates track the 5-year treasury. So as the treasury moves, those rates can move. Yeah. It's a little more dynamic on the pricing side than the kind of fix and flip construction aspect. But yeah, that's pretty much the product. It's pretty cut and dry, and it's really the loans are sized and kind of priced to a DSCR, a debt service coverage ratio. So if your rent, if your mortgage is $1,000, and you're getting $1,200 a month in rent, that's a 1.2 debt service coverage ratio. That's a 1.2 is typically where 1.2 and up is where you're gonna get the best pricing. Mm-hmm. I think we can go down to a 1.0. We do not go below a 1.0. Yeah. So 1.0 debt service coverage ratio means you're taking in the exact amount of rent that it is needed to cover your mortgage. And so
why would somebody do that?
You'd be surprised, man. Well, people will do that because they number one they believe they can get more rent than what the market study would indicate, right? Correct. So that's all done on an appraisal, and the appraiser would go and look at similar properties and what they're renting for, and that's the number we would use. Yeah. If you have a lease on the property and it's in excess of that, typically we're going to take the lower number because we're trying to be risk averse, right? Because if that tenant, even if you do really have it rented for more than the market, if that tenant leaves, there's no guarantee you're going to be able to find somebody else who will pay over market, right? So we'll typically use the lower number, but people might want to go to a 1.0 because they really believe they can get more rent than the market study would suggest, or they're playing the appreciation game and they just want to own that asset and think it's going to get more valuable over time, and they're willing to kind of break even on cash flow in order to do it.
That's pretty risky.
Yeah. Well, the really crazy thing is people doing sub 1.0 DSCRs, which there are products out there for that.
That's wild.
That product blows my mind. Like, I don't know why anyone on Wall Street would buy that, but they do, I guess. And so there's somewhat of a market, but it's not something that we do.
That's wild.
Yeah.
I think people in that position are probably playing the long-term appreciation, depreciation game. Because at a certain point, $50 a month in extra cash flow, $100 a month isn't life-changing money.
For sure.
So I would say they're probably playing that long game.
Yeah. Well, and one thing I didn't mention about the way that DSCR calculation is done is it also includes taxes and insurance. Mm-hmm. So, that all combined with the mortgage payment is kind of the number that we would use to compare against rent. And that's the other thing, right? Like, taxes have been going up in a lot of markets. Insurance is harder to get in a lot of markets. And so you can easily have a deal that pencils out pretty good, and then all of a sudden your tax bill comes and it's like, whoa, that was more than I thought. And now your DSCR is getting kind of tight. So, that's another reason to have that extra. For us, the best pricing is going to be at a 1.2 because you've got that
cushion.
You got that 2% cushion that if costs go up, or you have maintenance, hey, this house needs a new roof, right? Like, those things can really hit you.
Right.
And the tighter you are, the more that potentially has to come out of your pocket. And if something happens, your cash flow, personal cash flow is tight. That could impact the viability or the performance of the loan. And we try to make loans that perform.
Yeah. Well, it's great because because you have people that are local, and there's like this process that you guys bring people through. If anybody's got a deal that they're looking to get funding for, there's multiple points throughout that process where it's like, hey, this doesn't pencil out or this doesn't work. It's almost like you've got a whole team looking at your deal and letting you know, like, hey, we don't see the rents that you're calling for on this. It doesn't appraise for this. And there's been rare occasions where that's been for me when I've submitted a deal for financing. They're like, hey, we don't see the numbers. We don't see the comps. We don't see this. And I'm like, yeah, you guys are right. We missed it on this one, So it's nice to have that second pair of eyes to, and they're not just, lending out of getting people locked into financing,
Yeah. And in this industry, like, what we do is very interesting, right? Because a lot of I would say, lenders, and definitely everybody who's doing DSCR, nobody is originating DSCR loans and then holding them on their books. Almost no one. They all sell those loans. Yeah. And when you sell them, especially if you sell them frequently, then as the originator, some shops will be the discipline, the credit discipline can erode a little because they're not holding the risk. As long as someone will buy it. Like, there are some shops they'll originate a loan as long as somebody else will buy it. And they're just passing that risk on. That's not how we operate. Like, we really want our customers to succeed because we're in the long-term relationship business. and it doesn't help us if we allow our customer to do a deal that they may fail on, and that could be the last deal they ever do.
Yeah.
So like we want to keep our borrowers in business and support their long-term growth, which means that not every deal makes sense.
Right.
And so we try to have that conversation, and we try to do it in a very informed way by really having true local experts that you're working with, right? And you hinted at the team, every loan officer that we have on the team today is supported by what we call a pod. And those same people, underwriting, processing, closing, they work with that one loan officer, and that's all they do. So they're not jumping around to deals in Charlotte and LA and Seattle. They only do Charlotte stuff. So they get to know the market. And then for our customer, you're working with the same people over and over. So they get to know you, you get to know them. And hopefully, and I love hearing that our customers feel like our team is a part of their team. It's leverage for the borrower to make sure that they're doing the right deals.
Yeah.
And sometimes we have to have those conversations like, hey, I see what you're trying to do here, but I'm not sure this one is penciling out the way you thought. Let's look at it again. And sometimes we're wrong, and we have that conversation and come out the other end going, hey, this does make sense. But it's a conversation, right?
When I first started investing, I started, and my original like online guru that I was following was Brandon Turner.
Okay.
And so the big thing at the time, Bigger Pockets, all the books, it was the Burr method. And buy, rehab, rent, refinance, repeat. And that was like the impetus of my investing journey. I was like, I'm going to buy and rehab and, refinance like all these rentals.
Yep.
But you mentioned earlier the increasing cost of taxes, insurance. I have some rentals where the tax bill came back and it more than doubled, 2.5 times what it originally was. And now I went from making money to losing money every month. And so I had to sell it off, right? Where do you see things going with, you mentioned tariffs, you mentioned increased taxes and insurance, all this stuff. The DSCR rates are going up and down. Like, I know you don't have a crystal ball.
I do not.
But what do you see? What do you see? What's going on in the market right now for those of us that aren't the intellectual or as in touch with what's going on in the capital markets?
Sure. Yeah. So, I mean, again, it's very regional. So there are markets where, DSCRs are looking great and rental properties are penciling fine. There are markets where it's a lot harder. And Florida and Texas are probably the two examples of the best two examples of markets where, taxes and insurance have become, definitely a major hurdle. I think what we're seeing now is fallout from the post-COVID sort of reshuffling of America, right? You had all these people that were living in some city they hated, and all of a sudden they can work from anywhere and keep the same job. And so people flew, they migrated to places that they wanted to live. And, a lot of people were seeking lower tax, Texas and Florida both don't have state income tax. They do make up for it in property taxes, which a lot of people don't fully recognize. I can tell you from my personal tax bill, they get their money somehow,
one way or another.
But there are some tax advantages to living in those states, and of course, I live in Austin, Texas. Austin's pretty famous for being a pretty cool place to be, and so a lot of people moved to places like that and overheated the market, right? And I think what we're seeing now is, a lot of supply came on, a lot of new demand pushing prices up in a pretty short period of time. And that was unsustainable. And now we're settling back down. And in the multifamily space and with rents in particular, rental housing, the supply, the amount of supply that came on the market in the last couple of years has been extreme. And you kind of see this with multifamily where the builders and developers of multifamily will sort of, all right, the supply of units is low. So they all go and put stuff into the pipeline, and then all of that stuff delivers at the same time. And then it saturates the market again. So then rents go up as the market, as the supply tightens, and then everybody puts new stuff on the ground and rents come back down. And we're seeing that, but real estate is very cyclical. Probably not the first person to say that on this show, but right now there's no there's almost no new permits for multifamily, right? So you can just play it out in the next couple of years. There's not going to be any new supply for a few years because it takes a while to put those things together. And then all of a sudden you're going to see a whole wave of new development. But in that process, rents will go back up, right? So I think rents move around a lot, and it very much depends on where you are. I know this market has been hot and prices have gone up, rents have gone up. I don't know how stable rents are here, but this is probably one of the better, markets. And obviously, you've got Raleigh and Durham. What is that, to the north from here? Yeah. A lot of stuff happening up there, and really this whole part of the country, and a lot of that driven by it's been a lot more affordable here than it has been on the coasts and places like Texas. And so that's a good thing for investors. Like slow and steady is good, right? Yeah. What you don't want is these big jagged ups and downs,
right?
But I still think there's a lot of fallout from the post-COVID sort of migration, and I think that'll settle over the next few years, and I think things will get a little bit more predictable, I hope. Although we are in an environment today that's a lot less predictable than most people would want. So that just is what it is. But yeah.
Interesting. I remember the very first rental that I bought and went through the process, fixed it up. I did everything that the book told me to do. And then I went at the end and did the refinance, and the rates that I was getting back, it was like 6.8%. And I was like, this is robbery. But everybody else around me was paying, in the 4s or whatever. I was like, why? I mean, it was my first one. I was super inexperienced. And so, rightfully so, they were charging me on the high end, but now that's a good rate for some of the DSCRs that I'm doing now, So
yeah, the world of rates moves around a lot, but what's great about these DSCR loans is there is the ability to refinance. Now, a lot of them, for people who are not familiar, a lot of them do have a prepayment penalty. So unlike a consumer loan, so there's regulation that prevents lenders from imposing a prepay on a homeowner. Right. Because they don't want you to be trapped in your house. Right. If your job changes and you need to sell it, you need to be able to sell it. In the investor world, that's not the same, right? There's the regulation doesn't exist. So typically the loan is more valuable to the end buyer if they have some predictability about how long it will be outstanding, because then they know how much they'll make, and then that leads into what they'll pay for it. Right. And so there typically is a prepayment penalty, but those typically have a step down penalty to them. So the best pricing typically is on a 5, 4, 3, 2, 1. So year one, if you pay it off, it's a 5% penalty, and then it steps down to 4, 3, 2, 1. Right. So you can kind of think about that as it's like a 3 or 4 year loan, and then you might have to pay an exit fee. Yeah. Right. But if the deal makes sense, or if you're ready to liquidate it and you have enough equity, you may not care. Right. There's also 3, 2, 1 prepays, and then we go down to a 1 year. We might even have a 0 year, but it's you pay for that, right? It's more expensive on the rate. And those are really loans for people who are for sure planning on selling that asset or whatever in the next few years. But otherwise, they do offer quite a bit of flexibility after the first couple of years. And then, as rates move around, you can refinance and continue to hopefully increase your cash flow over time.
Yeah. Let's talk new construction.
Sure.
It's been a sexy, new, hot asset class in the last couple of years, and I see a lot more people getting into it, and I have some concerns if I'm honest. Yeah. Of not necessarily oversupply, but because it used to be, it felt like the barrier to entry to start doing some of this stuff was like really high, and now it's you got easy access to capital. There's fee builders, in every major market that can build a house for you. And there's a lot of new construction that's been happening in the last couple of years post-COVID. What are you guys seeing as far as volume, some of the market, the demand for new construction? Because I can only see what I see on the ground. You guys may have a little bit more of a global perspective on it.
Yeah, it's a good question. I don't know offhand what the percentage of our originations today that are new construction, but it's a good amount for sure. And I think a lot of that is driven by the mortgage rate lock-in effect, right? There's not a lot of houses. And that's changing, like, inventory is coming up, but like existing home sales are fairly, like, historically fairly low. Mm-hmm. But there's a huge demand for housing, and prices remain elevated, and that's going to remain the case as long as supply is super tight. So not to get into economics with everybody, but that's kind of the supply demand aspect of it. So I think a lot of people have migrated to new construction because it's so hard to find existing homes to buy and renovate. Yeah. Right. So because of the tight supply on existing homes for sale, because a lot of people are just not selling if they don't absolutely have to, then that's kind of where the new, and over the last few years, that's where most of the sales have been, is new construction. So, I think that there's a market driver to that. I agree that it is, it's something that, you can, end up with a lot of new supply that can kind of, change the market a little bit. I'm seeing a lot of that actually here in this part of the country. You see a lot of it in Florida and Texas and the Midwest. There's a lot of stuff going on in the Midwest as well. But, there's also some of these older parts of the country have more existing homes that are now so old that they really need repair. Right. The newer parts of the country, not as much, right? Not as much old supply to turn over. Like Chicago, man, there's an endless number of like 6-unit apartment buildings all over that city that are really old and really need to be renovated. So we don't do as much new construction in those more mature cities. Mm-hmm. It's more of the upstart, or not upstart, but like the younger, more growing, quickly growing areas of the country that have access to a lot of land. Yeah. But I would say that we try to be pretty careful with new construction, I think, for some of the reasons you mentioned, but also if you haven't done new construction before, it's a lot different than doing a rehab deal, right? Now, the advantage is that on a new construction deal, you know exactly what you're getting into. You're not going to open up the walls on a rehab and then learn that, oh my God, there's another $40,000 worth of work in here. Yeah. So you don't have the surprises. It's a little bit more straightforward, but it is much more of an intensive project, and you can make a lot more mistakes. There's just more opportunities to make mistakes. So I think we try to be really thoughtful about the sponsors we work with on those types of deals to make sure that they're capable of getting them done. And we've got to be experts in every market that we're in to really understand how much, what's the absorption of this type of asset, right? Yeah. We're seeing a lot of investors go from, it's funny enough, I feel like over the last few years, there's been to your point, a big push and a lot of people talking about, hey, I'm going to get into new construction because the margins are better, right? As renovation deals, as materials and things get more expensive and it's harder to buy the houses, right? It's the profit margins go down. You can kind of protect your margins a little bit better on a ground up deal. But we're actually seeing a lot of our most experienced investors going down the ladder. Instead of going up to a more complex project like a ground up, they're going down and trying to do much more affordable where that's possible, smaller deals, lower price points, because those deals can be absorbed by the market so much faster and more predictably. But if you're going into like, I don't know, name a city, and trying to build a $2 or $3 million, ARV home, like there's not that many, depending on where you are, like the number of people who can afford that house at today's interest rates is much smaller. Right. And so you're taking more exit risk. And so we're really trying to focus more on the more affordable price points. And then where we do the luxury stuff, it's got to be the right market with somebody that really knows that luxury market. Yeah. And, jumping into that from having a background of doing, $300,000 flips into a $2 million ground up, that's a big jump. Right. And so we try to be very thoughtful about that part of it. Right. Have you done this before? I know you've done a lot of other things, but so that's kind of how we think about it. But it's definitely been a trend. And I think you're going to continue to see it as long as rates and home prices remain elevated. At some point, rates will probably get to a point where it unlocks some of those folks that are just sitting on, super low mortgage rates. Right. But we're not getting anywhere near those rates anytime soon.
No.
So I don't know what that number would be, but
I mean, that's a once in a lifetime opportunity.
yes.
And I don't think we'll ever see that again in our lifetime.
Well,
but
and
then I've also said very dumb things in the past that have come true. So,
well, to your point, none of us have a crystal ball here, but I think that I hear people talking about that and like, oh man, why can't we get down to those rates? And I keep telling people, like, you do not want those rates. You know why? Because the thing that gets us to those rates is a really bad thing.
yeah.
Like there's going to be so much other pain if we get down to that point that it's not worth it.
Yeah.
So,
But those first 2 weeks of COVID, it was pretty fun.
yeah,
You know?
well, yeah.
Like everything shut down and it was like spring break all over again.
Yeah.
You know,
I played a lot of golf.
What do we do?
Yeah.
Work was shut down, you know, notwithstanding all the death and tragedy. That was terrible.
Yes. Obviously that, there was a lot of negative things about it, but it was an interesting time. I was living in Chicago at the time, and, I'm used to getting off the train in the morning and there being thousands of people in the streets walking to work. And then all of a sudden it was like that scene from Vanilla Sky, you know what I'm talking about, where Tom Cruise is in the middle of Times Square and there's no one around. That's what it felt like.
That's weird.
It was a very bizarre time, but definitely people who bought at that point made some pretty good investments.
Yeah.
Especially the long-term side.
You mentioned earlier that some of the operators that you guys work with, they're going, down the ladder to, are you talking about like smaller houses at small, like lower price points? Like where we see this affordability issue right now, where are people going to be able to create product for the market that is affordable? Is it just smaller homes? Is it mobile homes? Like what's the solution to it?
It's a combination of all those things. There's a lot of markets that are really embracing ADUs, additional dwelling units, or auxiliary dwelling units, depending on where you're at, which are, it creates the ability for somebody on a, normal size, urban lot to build a second unit. And those units are typically under 1,000 square feet. That's a density play, and, using existing lots with existing homes and just adding more density. That's a huge driver, and certain parts of the country are like Seattle and San Diego, both really embracing
Blowing up
that. So it's that kind of stuff. And then I think it's the ground up development, or just that kind of, they're trying to fit within that affordable band, because I think the data would suggest that, rates might come down a little bit, but they're not going to come down a lot probably.
Yeah.
And so, if you're kind of, and historically these are not high rates, right? But relative to the last 5 years, they're pretty high. Yeah. So in a sort of elevated rate environment and no real prospect for those rates to come down meaningfully, I think people are really starting to look at like affordability and trying to, again, like the velocity, right? Like you're in this business, the faster you can complete and sell, and then you turn that money over, you're amplifying your returns. So the deals that are going to sit on the market for 4 months, like those are painful deals, because you're paying the debt service on that. That's eating directly into your return, and you're not able to start the next project until you get that cash back. Yeah. And so a lot of people are just really opting for more velocity, and they're willing to take a little bit lower margin to have more predictable exits. And the other thing is that the lower priced properties also do better in terms of penciling for a DSCR. So not only could you be selling that house to an end user, a homeowner, but you also have the secondary exit of selling it to an investor who's going to rent it. Yeah. Or you could refi it and rent it yourself, right? So you just have more options, and the more options you have, the more predictably you can get in and out of the deals. Yeah. If you do a $2.5 million house, that is not going to pencil on a DSCR that any normal person would pay in most markets, right?
You only have one exit.
Exactly. You have to sell that to a homeowner. Yeah. And the ability for somebody to afford that is tough, right?
Interesting.
When you go to LA, everybody lives in a $2.5 million house. So, again, market specific. But, I think at the end of the day, that's what I think the most savvy investors that we work with. And listen, it's a spectrum, right? There are people who are just killing it in ground up in certain price points. And and what we believe is like, do what you know best, right? I think people get in trouble when they start jumping around trying to sort of time the market. Like, ooh, this is a good time to do that, but I haven't done it before. I'm going to do it anyway. That's dangerous. I think if you know something really well, if you know the market and you have a good handle on it, like you do here, you continue to do what you do well. But I think that we're seeing a subset of our kind of, most experienced borrowers that are really trying to maximize the velocity that they can get those assets moved. And if you have a big operation, you might have the resources to be able to do more deals and, in order to make the same amount of money.
Interesting.
Yeah.
We're going to have to make some smaller house plans.
Man, it's pretty crazy. Like some of the stuff that you're seeing, like, and Austin's a bad example, but because I live there, I mean, there's people selling ADUs in the back, like literally in somebody's backyard, and people are paying $800,000 for 900 square feet.
What?
1,000 square feet. Yeah.
For an ADU?
Yeah.
Wow.
Yeah. I mean, and maybe that pricing is a little outdated, but still, like, people are paying way more than you would expect for very small homes because the pent up demand. There's so many people that feel like they just haven't gotten out of the starting blocks. If they can afford it, they're jumping on owning.
Yeah.
Even though the math on owning is pretty bad right now in most markets, right? It's a lot cheaper to rent in a lot of places.
It's true.
But there's a lot of people who are just, hey, in order to start the family, I need to buy the house, right? And so we're seeing that a lot. But yeah, I mean, it's kind of all over the map. But that is I thought it was an interesting phenomenon that we've been observing.
I've also heard a lot of guys have been going towards the full gut, like the full on, because those have been things that I've shied away from, and I know a lot of other investors have shied away from. And so it's maybe left this void in the market where people don't want to take those risks. And so those ones that are the full gut, like just all out remodels.
Yeah, like the burnouts and stuff like that.
Like there's those guys that are willing to take that on, that they can get it for the right price and they can make it pencil, just there's opportunity everywhere. You just gotta.
And that's right. Getting it for the right price, right? Like if you know the market well enough, and any time like supply gets really tight like this, that it spurs creativity, right? People are like, oh man, and being able to find the assets. I mean, that's when I go around, we do events in local markets all the time, and I travel around and kind of host a lot of that stuff. And so I talk with these investors that are, in various markets. I was in Jacksonville recently. We did one in Detroit the other day, and you talk to these folks, and that's what everybody says, man. It's so hard to find a deal that pencils. Like, you just have to work a lot harder these days in a lot of markets to find deals that actually make sense. And so it's not surprising that people are kind of going, oh, well, nobody's looking at the burnout. So if I can kind of figure out what I need to pay and what the costs are going to be, it's just math at the end of the day.
Yeah.
So it's not super surprising, but it is interesting, right? Yeah. People do all kinds of weird things.
I don't want to say I'll never do one of those again, but I will never do one of those again.
I think there's
just scrape it and build new.
Yeah, well, and that's right. Like there's a lot of benefits to just doing what you know really well and sticking with that, right? I think that's one thing that we've done as we built our business. Like there's a lot of stuff we could do, but we try to be really great at certain things and then just not get distracted with the rest. And we've kind of taken that and put it on steroids, right? With all these different offices around the country. But I think for investors like yourself, right? Like, this part of the country extremely well, and that gives you an advantage. And so, using those advantages that you have, and not getting too distracted by the shiny object, which candidly, I mean, a lot of entrepreneurs really struggle with, right? I mean, it's one of the things that, sort of common thread with a lot of entrepreneurs. But if you can kind of figure out how to really focus and get excellent at certain things, just do that, right? And I think that goes for geography too. We're both in Collective Genius, and I hear people talking about, oh, well, how are you going to grow your business? Well, I'm going to expand into a few other markets. That might be a good idea, but there's a lot of learning that you're going to have to do, right? Every market is different. And, there are a lot of things, if you don't know, you can get burned. And You take a lot of risk when you do that, and you start spreading your focus. And the more wide your focus, is spread, the more chances you have to make mistakes. Again, in an industry that can be pretty unforgiving with mistakes.
Absolutely. My goodness. Okay. This is one that I do want to talk about. And a lot of lenders, the shiny object with people who are looking for financing is always the rate and the points, and the points. But there's a couple other things that I have found to be almost more important for me when I'm working with lenders. And it's I don't know what category you would put this in, but it's like draw schedules, the draw fees, the process for getting draws, the inspections, all that stuff that happens kind of post closing.
Yeah.
You may have somebody who can beat another lender by, 1 basis point or 10 basis points, but their draw fees are, 50 or $100 higher, or you have to actually go to the property yourself and take the pictures and upload them. And it takes you 40 minutes because you're in Salisbury and the connection sucks.
Yeah.
There's stuff like that I don't know what you would categorize that as like intangible benefits or drawbacks, but talk to me about your guys' process. How do you guys structure that?
Yeah, it's a great question. So we have really, one of the things that we've done is, a lot of firms in our industry kind of started as like side projects, and then they sort of, oh my God, there's all this demand and all these people want, non-bank financing, and these businesses have grown organically. And a lot of times what that ends up looking like over time is sort of, there's not a lot of cohesion in the way that their system works, their processes and teams and stuff. And we've taken a very different approach where we've really purposefully built every aspect of the business to deliver an extraordinary level of customer service. And those are the things that you're discussing, right? It's finding ways to make our customers' life easier and more predictable. I mean, predictability in your business has to be one of the most important things too, right?
Absolutely.
Like somebody who says they're going to do something at a certain time and then they don't. Hey, this closing is going to be here. And then it's, oh no, it's a couple of weeks. And like that throws you have so many balls in the air, right? And you have crews that need to go from A to, this project to that project. Like it really can be disruptive. And so we've just tried to get really great at that. And by coming from the borrower's perspective, like what are the things that are really important? Bankers don't know, right? And that's why I think we have a great industry, because the Wall Street banker types, they look at the world through a spreadsheet. They don't know what it's like on the ground. So, coming at it from the borrower's perspective, we've just really tried to design it in a way that's very friendly to the customer and tries to relieve some of those pain points. You mentioned draws. That's a big one because that's how you keep the project going, right? If you get done with a phase of work and you submit a draw and it's 2 weeks until you get your money, that's 2 weeks that you're having to have more cash out. And potentially your subs and other suppliers are not getting paid in those 2 weeks, which strains your relationships with them and all the downstream effects of that. So we just try to be really great at that. And what great looks like is just, being responsive. We don't really farm this out. We have our own people that do draw inspections. We have technology around it as well. So you don't need a person. I'm not sure if you use, the tech aspect, but, you can schedule a draw inspection virtually. It's through basically a FaceTime app, and you can have your GC or your contractor do it. You don't have to be there. And they basically get on a FaceTime with our asset management team, and they walk the house together, where our team in the office can see through their camera and they can take all the pictures. You don't have to take any pictures. They can turn your flashlight on if you're in a basement.
Wow.
But there's a customer service element. It's not you or your contractor taking photos and uploading them into a void. You're actually talking to somebody.
Yeah.
And that's an important part of the process too, because the draw, I'm sure you've experienced this with the number of deals you've done, is, it's not always black and white, cut and dry. Right? Like, hey, I've got all this drywall, but only this is installed, and I've got a little bit, but the guys are coming tomorrow. And so we just try to take a really practical approach to all that. And, yes, there's some risk management there, but if we know the customer, if we know, if we've worked with them before and we know how they operate, sometimes we can, all right, we'll give you a little more for this, even though it's not all installed. And, hey, hey, what about, there's things that we can do to try to make it easy and not be so rigid that it makes your life harder.
Yeah.
Right. Without increasing the risk of the project. Right.
Yeah.
And so we try to do that kind of stuff, but the responsiveness and the timeline is really important. Like I said, I mean, our goal is to get every draw out, 24 to 48 hours. And we try to make sure that we can get to the project either with a human or on the tech side as quickly as possible so that you can keep the cash flowing, keep your people paid, keep moving forward. And then I think the process on the front end, because what you're talking about is kind of post-close. The process on the front end, we really try to smooth out by, having the same people work with the same customers over and over. And then, we hire our team for customer service. I mean, the production assistants, the closing coordinators, they're all customer facing people. And the kind of the main thing that we care about is customer service, right? Yeah. It's kind of the most important thing. So the process is designed to have a ton of transparency, a lot of communication, and the expectation setting has to be really good. And then we have to be able to do what we said we're going to do. Yeah. And those are the little things. And I think in an increasingly competitive lending environment, and there's a lot of capital in the lending environment right now. I think that's when we do the best is when, as long as we can be competitive with rate and terms, I think the little things is where we separate. And sometimes they're little and sometimes it's 5 or 6 little things that all add up to a big thing. Mm-hmm. But over a long period of time with our customer, I think we can make their life easier as we go. And we just really make that a focus of the way that we put the business together and how we manage the team.
Yeah.
Customer service, if I can go on.
Go for it.
The customer service thing, I do think it's important. So we use Net Promoter Score to gauge customer satisfaction. So for anybody who doesn't know what Net Promoter Score is, it's you've probably gotten the survey before, right? On a scale of 1 to 10, how likely are you to refer us to your friends or family? And the friends or family part is the important piece. It came out of a Harvard Business Review study 25, 30 years ago. But basically it said that if you're willing to introduce somebody to your friends or family, people that you have a personal relationship and a stake with, then that's the highest, indication that they were satisfied. Mm-hmm. People will tell strangers whatever.
Yeah.
But your grandmother, it's a little different. And so we have that, we send that survey out a couple times during every loan. And one of the ways that we really get consistently good service from our team, which is about 300 people now. Anytime someone fills out that survey, so anytime you've ever filled it out, the score and any comments that they write, they're automatically emailed to every employee at the firm. So every single employee, doesn't matter their role, every single employee sees every piece of feedback in real time, unedited, every day.
So that one nasty thing I wrote about Susan,
it's
everybody
funny.
Saw that in Renovo.
Yeah.
I'm going to do that.
You should. It's fun. Sometimes people will do that because they know that the company reads it and they'll throw in jokes. But no, every employee sees every piece of feedback, and it's just constant reminder of the customer service is the most important thing.
Yeah.
And so anyway, I think we just try to bake that into every aspect of what we do. And those are the things that separate us, right? We're not going to be the absolute lowest price most of the time, but if we are within a few basis points, then all the other stuff matters a lot more. And that's where we kind of thrive.
Yeah, I like it. I'm going to say Susan smells like beef and cheese in the next NPS email that I get.
Well, now it's not going to be a surprise, but
not all 300 employees from Renovo are watching.
That's a good point.
Yeah,
that's a good point.
This was great. And I hope it's been helpful to people watching. If people want to keep up with you or get in touch or find out more about Renovo, what you guys have to offer, what's the best way for them to do that?
Yeah. So renovofinancial.com is our website. A lot of information on there. And me personally, you can catch up with me on LinkedIn is probably the best way. I'm also on Facebook and Instagram, but James Gaskin on LinkedIn. And then also we do, and I host a podcast. So anybody who's interested in learning more about, the lending aspect of what we do, it's called The Hustle Harder Show. And it's available pretty much anywhere you get a podcast. And those are probably the best ways to keep up with me. And always happy to connect with folks too. And if you're interested in exploring a loan, I can facilitate that connection to our local teams to get that done.
Sweet. Awesome. Thanks for coming on.
Thanks for having me. I had a great time.
That's all we've got for today's show. If you loved the content, please leave us a rating and review. It really helps us grow. If you want to follow along my journey as a real estate investor, you can go to builtforwealthpodcast.com and you'll find all of my social links there. Thanks for listening.